what does a venture capitalist get in return for all their investments? Well, let's look at an example of a successful venture capital return. It looks like this. For every 10 investments, one of them needs to return at least 10 times what the venture capital put in. And just to be clear, the venture capitalists generally don't put in all the money at once. They'll give an investment in the first round of money. That'll last a year, and in most venture scale businesses, they'll then put in more money the second year, more money the third year, and usually that's enough to get the company to profits. Right? So all in all, they'll make a $5 or $10 or $100 million bet in a given company. And what this tells you is that for those bets, let's just say it was $10 million in, at least one of those $10 million bets needs to return $100 million or more. That's 10 times what the venture capitalists put in. And they don't know which one it's going to be, right? So they might be professionals. They might do this every day for a living. Still, it's a hits business. They don't know which ones are going to be the home run hits. So every single investment they make, they expect to be a 10x. And the reality is that only 1 out of 10 at best is that 10x. And I want to be clear, it's not always 10. It could be 8. It could be 20. Some lucky VC out there saw Facebook and said, yes, we're going to invest in that. Somebody saw Google and said, yes, we're going to invest in that. Or even way back in the day, Apple or Intel, and said, yeah, we'll bet on that. Those VCs made 30 or 50 or 100 times their money, right? But nonetheless, the key is that 1 out of every 10 is at least 10x. Now, that aside, the next 2 are decent returns. And decent is 3, 4, 5, maybe 7 times return on capital. So again, $10 million in and 50 out. That's a decent return for venture capitalists. Next down the list is that 3 out of these 10 only return the capital the venture capitalists put in. That to them is a loss, right? So their job is to make money, and if they simply get the money back, that's not good enough. That's a failure on their end. And so there'll be protections. We'll talk about these in a bit, but there'll be protections in their investment that say, if we give you $1 million, we get the first $1 million back when this company gets sold. That way they have a much higher chance of getting their 1x back. And it might not be 1x, it might be 0.8, it could be 1.2, but it's around 1. And then 4 out of every 10 investments they make return absolutely nothing, are total zeros. So take a step back and look at this again, and notice that professional investors, professional venture capitalists who get to look at 2,000 deals a year and pick 5, right, in total maybe per year, at best they're making 3 out of every 10 successful bets and 7 out of every 10 investments they make, all of which they think are going to be 10x returns, but 7 out of 10 of those bets are not successful. Right? It's kind of sobering results. And so what this tells you, right, the weighted result of this is that 10% are 10x and 20% are 5x. More or less, they're going to get about 2.5 times their money back in 6 or 7 or 8 years, 10 on the outside. Right? When you look at that in terms of interest rate, the equivalent interest rate, it's about 20%, 20, 25. So it's way better than bonds. It's better than stocks. It is a good return on investment. It is a good risk-reward ratio when it works. The problem is it doesn't always work. So if you look historically at what's happened in the last year and 3 years and so forth, if you look back all the way to 10 years, in the last 10 years, the total investments put into venture capital did not return as much money as an equivalent amount put into the public stock market in the United States, the S&P 500. And there's lots of reasons for this. 15 years ago was the dot-com bubble. But in the last 10 years, that's the span of time since Google went public, at least when this video was shot. In that time, on average, the venture capitalists have been unable to hit this 2.3x return, right? When you look at the numbers, they're in fact missing the 10x more often than they're hitting it. So it's kind of interesting to look at. Nonetheless, it doesn't help you raise any money. What's more telling for you is to look at the research that's been done on angel investments. And unfortunately, whereas every venture capital investment is tracked in some manner, very few of the angel investments are tracked at all. So there's been a whole lot of research on whatever data that's been put together, a decent set of data, to show what happens in real life. Well, here's a set of results from about 1,500 investments across a wide variety of geographies and time. And what it shows is that most of the time, angels will have the same general return, overall multiple of 2.6, real data, real investments. But what happens for angels is that most of their losses, most of their returns that are less than 1 on this chart, which is mostly the zeros, they learn about those in 3 years. The ones that are 1x's or better, or 1x to 5x, they won't learn about those for 3.5 years. The ones that are the good returns, 5 to 10x, take almost 5 years, and the ones that are better than that take more than that. And so what we see on average is it takes about 6.5 years for a successful investment to come back to an angel. But it only takes 3 for them to see the bad returns. So in terms of standing in the angel shoes, the problem with angel investing is it feels like they're making losses for many, many years because the successes take a long time. As an entrepreneur, what you should note is that tracked data shows that angel investments on average, when successful, take 6.5 years. So if you're thinking of flipping your company in 3 to 5, maybe you should think more like 5 to 7.